Welcome back to Kitco News. I'm Jeremy Savrin. We begin with breaking developments in the global economy and markets. The World Trade Organization has just issued a stark warning saying the global trade outlook has deteriorated sharply due to a surge in tariffs and rising policy uncertainty. In its latest report, the WTO is now forecasting a 0.2% decline in world merchandise trade in 2025, with North American exports expected to plunge more than 12%. And if so-called reciprocal tariffs are fully implemented, global trade could fall as much as 1.5%, hitting developing countries the hardest. All of this comes as U.S.-China trade tensions continue to rattle markets. Overnight, Nvidia shares tumbled after the company announced a $5.5 billion charge tied to U.S. chip export restrictions. And that, of course, dragged down semiconductors and big tech, with the Nasdaq falling more than 2% at the open. Meanwhile, gold is doing what it does best in times of turmoil. It's surging to new all-time highs. June gold futures jumped $83 to hit $33.34 an ounce. That's $3,334, a crazy number here, driven by safe haven demand, especially from Chinese buyers, both in retail and central bank. Now, silver also saw strong gains, approaching $33, and still not everyone is on the same side of this trade. A new Bank of America survey has flagged gold as the most crowded trade on Wall Street, raising questions about how durable this move really is. So, where do the markets go from here? We got record highs in gold, rising volatility, and signs of macro exhaustion in the equity space. My next guest was spot on back in June 2024, where she told us a lasting commodity bull cycle was taking hold. And since then, we've seen major rallies in gold, silver, and even copper. Now she's back with a fresh technical read on what's coming next. Joining me now is Katie Stockton, founder and managing partner at Fairlead Strategies. Katie, thanks for being with us today.
Of course, glad to join you.
Okay, well, we got lots to get into, including what I was just talking about in the intro, this latest WTO, announcement. They're issuing this stark warning that you heard, and it's about the global trade outlook and how it's going to be deteriorating sharply with President Trump's new tariffs. U.S.-China trade tensions continue to be a drag on the markets. We're seeing that safe haven flow surge here. How are you reading this moment technically? I mean, is this the start of something bigger here, Katie?
It appears to be just that. So we have some indications from our long-term charts. We analyze the markets using price trends and also momentum indicators. And the loss of momentum behind the S&P 500, as you can imagine at this stage, is very serious. It has manifested itself in our monthly indicators, meaning that the momentum gauges have flipped from buy signals where they had been for a long, long time, about 2 years, to now a sell signal. And that suggests that it's going to be a challenging year for equities. We've already also, seen that from our other metrics, and we've seen breakdowns from the major indices. So now it's become quite obvious that we're in a different type of environment characterized by more volatility for equities. And as you mentioned, Jeremy, we do have a very good rally underway in the price of gold as probably the primary safe haven asset class, and in other areas of the market that tend to be a little bit more defensive.
Interesting. Okay, well, I want to get into the S&P, and we got to talk Nvidia too. But before we do, let's just talk about gold here for a second, because as I mentioned, it just hit this new all-time high above $33.34 an ounce. It seems silver is rallying too. Are we looking at another leg up in the precious metals bull run, or is this move maybe running a little hot here?
Well, I think we want to stay with the momentum behind gold. It's obviously very positive, and that goes for all time frames. We look to that end at monthly, weekly, and daily bar charts, and those indicators there are all positive. For the first time this month, we do have some indications of potential upside exhaustion from one of our overbought, oversold metrics, but it's not to the extent that we would react to it yet. We're just going to scrutinize those momentum gauges maybe a little bit more closely with that in mind. We don't have an upside objective because our objectives have been met and exceeded. So the best thing we can do is keep those moving averages and indicators on our side. And right now they do point to higher prices for gold. The rebound in silver is pretty impressive, but silver did see a bit of a shakeout or potentially a breakdown below short-term support. So we're a bit worried that that's something that could indicate that it will continue to lag the price of gold.
Yeah, interesting. I mean, you called this commodity a lasting commodity bull cycle, and you were talking to us back in June 2024 about a beginning. Call has aged extremely well here, Katie. I mean, even on the copper side, they've all broken out since. Talk a little bit about what the charts are saying to support the upside from here, because you mentioned it's a little bit of a dicey possible weather for silver, but gold, still some room.
Yeah, gold still seems to be the standout of all the commodities, really. We have not seen the kind of upside that we were looking for from the price of crude oil. It had gotten wound up in a trading range, sort of a triangle formation on the chart, and recently broke down. So that's diverged, of course, from the commodities that have seen their prices go up. So natural gas actually being one of them. Natural gas appears to have a long-term basing phase in place, whereas crude oil has a pretty fresh breakdown. So there's been divergence, I would say, within the commodity complex more broadly. And in general, we want to stay where the momentum is and stay with those winners. Copper has seen long-term momentum shift to the upside, but very volatile from a short to intermediate term perspective. So I think it's important to, sort of play the swings there if you're involved.
Yeah, it's been fascinating too watching. I mean, we got some insight from the White House talking about critical minerals, but when it comes to some of the precious metals, we don't have a ton here on the tariff front. Could this expectedly change if any of that comes to fruition?
Listen, the market's very prone to headline risk, is what I would say. We don't know what's coming, and I think it's that uncertainty that you're seeing reflected in risk assets broadly, especially equities around the world. So we have no way to predict the headlines, but of course we can judge the reaction. And so far, the reaction has not been positive, as you know, and the reaction from gold has been positive, right? So that's a message right there. It reflects market sentiment. Sentiment has been incredibly bearish. If you can check the investor polls, you can reference things that are more transactional, like the volatility index, and you can see that bearishness is at extremes. Usually that's associated with short-term lows in risk assets, but I emphasize short-term because the major lows, the long-term lows, often occur well after that first volatility spike, which is what we just had.
Interesting. Okay, well, let's talk ETF strategy and positioning here, because you've said that one of the advantages of your TACK ETF is the ability to rotate quickly between sectors and into risk-off assets. With gold and treasuries now in the portfolio and tech being removed, I mean, what's your model telling you about the best defensive positioning right now?
Yeah, so it also leans quite defensive on the sector front, the TACK ETF. It has positions in consumer staples, utilities, and now real estate, which is what swapped out the technology sector. So we're very comfortable with that from a longer term perspective. Our long term is 6 months plus. We feel like the long-term gauges have shifted pretty meaningfully in favor of those more defensive areas of the market in terms of the equity sectors. The momentum gauges have shifted, the relative performance gauges have shifted, and a lot of that's a function of the loss of momentum and relative performance behind the mega cap complex. And of course, that seems to be where most people are very interested, and naturally so. And yet, with that loss of momentum there, it has affected most every other sector and even most every other international equity market versus the US. You've seen relative performance improve outside of technology with that pullback. So we do think it's meaningful. We think it'll characterize much of this year. And in following, we'd be comfortable not only having that defensive sector exposure, but of course, gold exposure. And we hold also short-term treasuries and long-term treasuries. And we expect those risk-off categories to grow as a percentage of our overall portfolio. And that's a great way to limit drawdowns when the equity market is under pressure.
Interesting. I mean, we're continue to talk about the equity market being under pressure. And I mean, your ETF still has a large equity weighting. I mean, nearly 87%, despite this turmoil we're talking about. So what would happen for you to dial that down further here? I mean, are we close to a full risk-off trigger based on these models?
Not close to a full one. So this is a model-driven fund based on our methodology. It's 100% systematic, meaning we refer to our models and act accordingly. And we do expect to remove more of the sector exposure or more of that equity exposure as things progress. The turnover on average for the TACK ETF ends up being about 100% per year. And we've seen already since its inception, which was in March of 22, it moved to just a singular sector ETF position, meaning only 12.5% exposure to equity. So we have seen that very dynamic nature of the portfolio in response to our methodology. So I don't know that we're going to have to get that small in terms of our equity exposure to react to the market. I kind of hope not, because that would mean we're in a tape that's much like 2022, but there are unfortunately some indications of that.
Okay, let's talk a little bit about this tech sector trouble, because I know you have a chart as well talking about the SPX. I mean, you recently flagged a major sell signal for the Nasdaq 100, the first since 2022, and now we're seeing Nvidia plunge after this announcement of that $5.5 billion charge tied to China's chip ban. Is this the beginning of a broader tech sector breakdown? I mean, what are you thinking here?
Yeah, so that loss of relative performance you can see in the chart behind the mega cap complex has been problematic, as you know, for the broader market, for the major indices. And it does appear to be the start of a more lasting reversal, favoring just about everything else, right? Not the mega caps, not the large cap technology sector. Nvidia, for one, has come into some support. You see it on the shaded area, the cloud model, we call that. On its chart, even with today's gap down, it's still above that support level. So we're looking for a rebound, and that rebound, I think, should be welcomed by investors in Nvidia to perhaps reduce exposure in anticipation of more of the same, which has been just a choppy, overall sort of downward biased environment for that stock, and also for many of its peers. We think that this is a relief rally that should be sold into for now, and that is still the secular uptrend is intact. So eventually we'll have an opportunity to revisit these mega caps once we have indications that long-term oversold conditions are within reach.
Okay. So you're not buying the dip right now at these levels. You're kind of waiting for it to shake out.
That's right. We're looking for a more, I guess, high conviction entry point. But for those that are holders, we would say maybe give it a couple or few weeks and reduce into strength.
Okay, I got to ask you about Bitcoin. I mean, is it missing the moment here? It was up about 1% since the tariff news, but it hasn't surged like gold, as we know. Galaxy's Mike Novogratz says Bitcoin is trading more like the Mag 8 stocks than digital gold, which you just showed here. From a technical perspective here, I mean, does Bitcoin still look like a hedge, or is that narrative breaking down?
Well, it's been more closely tied to the equity market of late. So it's being treated as a risk asset more so than a hedge by investors. And listen, that can break up. These correlations are at times cyclical, but that's what's happening right now. So we have seen a corrective phase that is very meaningful. It's impacting the long-term gauges for Bitcoin as well. We have currently a neutral long-term bias, and we think that we could ultimately see more downside follow through, sort of lower highs, lower lows, before we get that major low. And that major low is likely going to be correspondent to a major low in the equity market based on how things are trading. For Bitcoin itself, the initial support that we're watching is just shy of 74,000. It is a key level, and we'd love to see that level hold to contrast our views.
Okay. Market outlook here, Katie. I mean, we've seen this increased volatility, and your models suggest a move out of this low volatility cycle, as you mentioned. But talk to the investors themselves here. I mean, how do they prepare for what could be a much choppier road ahead, even with a longer term bullish framework?
Well, I think that the equity sector rotation is something that they can leverage in relative terms. So build the defensive sectors relative to the likes of the technology sector over time. And also that's especially for advisors who have to have equity exposure, and otherwise to move into those alternative asset classes like gold and to hold an above average cash balance. And to think of that cash balance as something that you can ultimately put to work and sort of reinvest in the market when it's a little bit of a better risk reward ratio in your favor. So we think there are ways to limit the drawdowns through this environment, and that's what we would be focusing on. But thankfully, 2026, we have some indicators that are suggesting that we should see a nice resumption of the uptrend then.
Oh, that'd be nice. We saw Warren Buffett go into full cash position almost here. I mean, cash seems to be key. We've seen the Treasury market continuing to lead on the interest side there. I mean, what are your thoughts here where the safe money is kind of going, besides gold as well? And more importantly, is there any red flags for investors, that you're really looking at here in the next 5 to 6 months?
Yeah, listen, we are technical analysts here, and so we primarily look at price trends, but we do often apply those indicators that we use to macro inputs. So one of them, and I'll show you a chart of this, is the chart of credit spreads. So credit spreads have effectively established what technicians call a double bottom formation, and that would suggest that credit spreads would widen from here further than they already have done. And that does present somewhat of a risk to the economy, or at least a perceived risk at this stage. And I think that's something we all need to respect and also, position accordingly. So be respectful of the macroeconomic risks out there and know that they probably have implications that are beyond the next couple of months, something that could take us perhaps into year end, if not slightly longer.
Okay, interesting. Some early warning signs. Katie Stockton of Fairlead Strategies. Thank you for this. Thanks for the charts, the insights, and the clarity on a market that's anything but clear right now. Always great to have you on.
Yeah, good to be here.
Thanks, Katie. Appreciate it. And thank you for watching. If you found this helpful, make sure to hit like and subscribe to our channel. Turn on notifications. We've got more market-moving interviews and smart technical reads coming your way. I'm Jeremy Safran. Stay with us right here on Kitco News.